yesterday, the chapter 1 just talk about some basic accounting terms, right? And we're going to talk about the accounting equations, which is assets equals liability plus owner's equity. So that is the one is gonna go with accounting courses, go with you for whole life if you go for an accounting career. So that is the major points we're going to talk about it is the accounting equation. But before we touch base on that, first we're going to talk about why is accounting important and who used the information. So accounting, what is accounting? The definition for accounting is the system that measures business activities, process information into reports, and communicates those findings to decision makers. So one of the most important parts for accounting is to serve the financial information to the decision makers, which are like senior managers, senior VPs, or executives. Those are the executive groups in the company. So the financial information will help them to make the decision to keep the business moving. Now, financial statements are the documents that report on individuals or an organization's business in monetary amount. Right? There are four actually, very important financial statements. We're going to go through that as balance sheet, owner's equity, income statements. And then there's a cash flow statements. We're not going to touch base in financial accounting to talk about cash flow statements because it's very difficult statement. About the cash flow statements, if you're getting a chance to study the management accounting, then we're going to talk about it in there. Now, bookkeeping is the procedures elements of accounting. People are sometimes get confused about bookkeeping and accounting. Sometimes we'll use the term refer to each other in the same context, right? But actually there is a difference between those two. Accounting is an information system used to measure, organize, report, and communicate information to decision maker. However, bookkeeping involves the physical reporting of business transaction within the accounting system. So think about skating is to hockey as bookkeeping is to accounting. So that's the two differences if you want to keep in mind. So this is the financial statements, which is talk about it and the flow of information to support a business decision making. Decision makers, the user of accounting information are people who need to make business decision. So this is exhibit coming from our textbook to illustrate the role of accounting in business. First off, individuals. Now the personal, right? Individuals use accounting information to manage bank account, make investments, and decide whether to buy or rent a home or an office. Business owners and managers, we just talked about that, right? Because they're as a senior executive type level. So those people use accounting information to set goals, evaluate progress towards the goals, and determine corrective actions if necessary. And then investor and creditor. Creditors determine a borrower's ability to meet scheduled payments on a loan by analyzing financial statements. Investors use financial statements to help determine, of course, to make reasonable expect from their investment. Government regulatory agencies such as Provincial Security Commission, they verify compliance with financial and other reporting requirements. Tax authorities, we require to do taxes, everybody in Canada. So tax authorities such as local, provincial, federal government, they connect taxes based on income. So income determined by using accounting information. Non-for-profit organizations. Non-for-profit organizations, they use accounting information to deal with budgets, payrolls, or other financial issues. The other users of accounting information, including like the labor unions, the third party, or consumer groups, or general public, okay? Like us, students who wants to know the information about company, they can just go search for their financial information. Financial accounting versus management accounting. We just touch base based a little bit regarding that, right? When we talk about cash flow statements. Now, financial accounting focus on information that will be useful to external users. External users such as investors, creditors. And management accounting, they focus on information that will be useful to internal users. So such as the top executives, department heads. That's why the cash flow statement is coming from management accounting, because the cash flow statements, mostly 90% of it is just serve the internal users to make these decisions. So that is kind of a difference between financial accounting and management accounting. So this is the form that you can find from your textbook. It's just comparing the users between the financial accounting and the management accounting. Now, when we move on to Canadian Professional Accounting Designation, we all know that CPA is one of the largest accounting bodies in Canada. They used to have 3 different former bodies, CA, Chartered Accountants, Certified General Accountant, CGA, and CMA, Certified Management Accountant. Then until recently, the organization decided to put all 3 professional designations just into one. That is CPA Canada. So we call Chartered Professional Accountant Canada. Okay. Auditors. So audits are an example of work done by designated accountant. If you get to know those 3 different accounting designations before in Canada, like CA, CGA, CPA, like auditors always coming from the CA, because the CA, even though the 3 different bodies are just towards the accounting destination, but they focus on different sides. For example, the management accounting, they focus on the management issues. Like I said, cost analysis, if the company needs to hire, or if you hire more people or lay out more people, or if there's a production line, we need to keep it production line, or do we need to delay the production line? So those kind of decision-making questions are basically towards to management accounting. CA, normally for auditors. So auditors, not just for like what is an audit, right? The audit is for a financial examination conducted by independent accountants. That is not accurate, because audit including internal audit and external audit. So if it's from the external audit, we have the third party, which is business will hire another accounting company to provide the auditors to examine the company's financial statements, if it's accurate, if it's good to go to release to the public. That is external audit. For internal audit is the employees from the company. So they are focused on the company's procedures, the company's policies. If the business department, or for example, the procurement, which is supply chain. So procurement department following the 3-way match. 3-way match is another different term for accounting match. So those are kind of a different company rules was audited by internal auditors. So internal auditors is not only examine the financial information, they also focus on the whole company's policy and rules. Still on the Canadian Professional Accounting Designations. Ethical matters. The importance of ethics in accounting is introduced. It's a very, very important concept to nowadays. We're going to talk about in one specific slide. I think we have this in there. It's in there, ethics in Canadian. Now, before we move on to ethics, there's another certificate we call an advanced certificate in accounting and finance. It's ACAF. It is alternative certifications for those people who doesn't want to pursue into CPA. But the ACAF is also provide an opportunity to expand your knowledge of the accounting, because CPA it takes so much time, right? It takes so long for people, and also it costs money. So, and it also requires a 5 or 6 years of experiences in accounting in Canada. So, which is kind of difficult for the new immigrants or just graduate from the school. That's why not everybody wants to pursue the CPA designation. They can have ACF for alternative choice. Now, ethics in Canadian professional accounting designations. Ethics is, we're going to talk about this topics for each chapters we're going to learn following, because ethics is one of the important, not just for accounting field, right? It's just very important for everything in our society to keep going. But the ethics for CPA designations, even though we need to renew our designation every year, but before you renew the designation, you need to read through a conduct of the CPA behavior. That is the ethic rules you have to follow. So the organization wanted to make sure all of their accountants are following that rules. And yeah, so it's very important. You can read through your textbook. It's giving you a detailed analysis about that topic. Now, moving on, we'll move on to the number 2 topic. We're going to talk about what form can we set up a company. Okay. There are 3 forms of business organizations. There are sole proprietorship, partnership, and limited liability partnership, and corporations. Mostly in our business examples in the textbook, we are talking about a corporation. Okay. But we should know what is the difference between those 3. Proprietorship is a business owned by 1 individual, and partnership is business owned by 2 or more individuals. And corporation is a business owned by shareholders. Okay? A corporation offers a limited personal liability to its shareholders. So that is just a very basic introduce about the 3 different bodies of a business. Now, what are some of the guidelines for accounting and why do we need them? This is also a reading materials. There's going to be a lot of reading materials. So if you could read your textbook, that would be perfect, because today, and even though we're going to go through chapter 1 and 2, we focus on that equation analysis. Okay, so those are the reading things. I'm just briefly go through it, but if you're interested or you feel like you lost it a little bit, just refer to your textbook and read it through. So what are the some of the guidelines for accounting and why do we need them? Accounting concepts and principles are guidelines that govern how accountant measures, process, and communicate financial information. The guideline we've been using is the General Accepted Accounting Principle. That is the GAAP. Okay, so that is always been the rules will be referred to all the accounting. As globalization became more common, okay, so the use of different accounting standards in different countries has become more problematic. So just imagine if you're in Canada, you've been using one of your international accounting rules, but in Asia countries, they use different rules. It's just so hard for the investors to investigate their financial situation. So that's why there is a new rules coming out for international investors. We call it International Financial Reporting Standard, that is IFRS. So Canada has joined much of the developed world in adopting the International Financial Reporting Standard, that is IFRS. So after we talk about each of the topic in accounting, we're going to go through what is the differences between IFRS. There are also a asset. Let's see here. Okay, so except for the International Financial Reporting Standard, there's also another one we call it a accounting standard for private enterprise. So that is ASEP. What is for the private enterprise in Canada, they have option if they want to apply the IFRS or they want to apply the ASEP. So In our tax book, that is all I'm going to talk about. In our tax book, for each topic, we're going to talk about it. For example, the receivables or liabilities or revenues. We're going to have one or two slides to comparison between the revenues in IFRS or revenues recognition in asset. So we'll see the difference between those two. Now, framework for financial reporting. That is the one refers to, I will talk about it. You can use the, you can just read the textbook for detail, but I will just briefly go through from the top to the bottom. The primary objective of financial reporting is to provide financial information that is useful for making resource allocation decisions and for assessing the performance of a company. So this is the pictures, is a framework pictures you can see from your textbook. It is a hierarchy of qualities that increase the value of information for decision making. We can see from the level 1, which is the top level, the yellow one, communicate useful information to users, right? So that is the objective of financial reporting. The level 2, so you move down a little bit. Level 2 identifies the qualitative characteristics for information to be useful. So those characteristics are relevance, comparability, reliability, and understandability. I think, yeah, so we do have it for to just quickly definition for each. So relevant, provide important information upon which you can base your investment decision. Reliable is the financial information is to be useful. It must be reliable. Comparable, you should be able to compare the information against the business own financial result in previous years. That means you have to keep consistent, right? You want to keep the same methodologies to use year after year. You don't want, if you need to change one of the accounting rules, then you need to put into the notes and see why you need to change it. We're going to talk about that, I think, in chapter 6, when we talk about the merchandise inventory. That will talk about a different methodologies, and also it recommends it if the company use one method for 1 year, the recommended company to keep use it for the following years. Because if the method you use changed, then you need to indicate it and to let your investor know why you made the changes. So it's very important for comparable. Understandable, it must be clear and concise, right? So the information is not misunderstood. See, some of the business, if the business encounters some unethical issues, he probably reported more income, right? Less expenses to make their net income look beautiful. So if there's something actually happened, then people will just simply put increase their net income, right? Or increase their expenses. So it all depends on different situations. So that's why we need to identify the qualitative characteristics that to make the financial information to be understandable. Now the next one, move to the level 3, is the elements of financial statements. The elements of the financial statements is very important. So keep in mind and memorize those assets, liabilities, and equity. That is one of the major things we're going to talk about today. Level 4 outlines some fundamental assumptions, principles, and constraints that financial reporting are based on. There are assumption, principles, constraint. The basic on the reading parts, I would recommend you to refer to your text by reading in detail of all those primary objectives of financial reporting. Now, then we move on to how do business activities affect the accounting records of a company. Now, pay attention to that part because it's very important. Now, assets equals liabilities plus owner's equity. Okay, so the accounting equation shows the equity between the assets and also the claims on the assets. Assets, what is assets? Assets are economic resources owned by a business that are expected to be of benefit in the future. Now, liabilities, examples of assets, of course. So examples of assets including cash, okay, account receivable. I guess students get confused about account receivable. Account receivable means the amounts owed from customer. Okay, so we put account receivable under assets, current assets. So just memorize that. Account receivable is under assets. Notes receivable, similar to the receivable, accounts receivable, sometimes including current or long term, depends on the term of the notes. Prepaid expenses like prepaid insurance or prepaid rent. We group all those under prepaid expenses and it's under assets. Land and buildings, capital, right? Capital assets. Equipment, furnitures, and fixtures, all those are under assets. So pay attention to the prepaid expenses and account receivable. Those are assets. Now liabilities. Liabilities are debts that are payable to creditors. So that's a liability. Examples about liabilities is like account payable, which means amount owed to suppliers. That's as a business, we purchase inventory from the suppliers, but we didn't pay for it. That is account payable. So because it's a liability, we need to pay. Notes payable, similar to account payable, depends on the term, either current liability or long-term liabilities, right? Some of the notes is within 1 year, but some of the notes is more than 1 year, so it's notes payable. Unearned revenue. Unearned revenue. Pay attention to the special term of the unearned revenues under liabilities. Unearned revenue means the money has been received, but the services and products hasn't been delivered to the customer yet. So that is a liability, even though we received the cash, but because we haven't provided our services to the customer, so it's also a liability. Owner's equity. Owner's equity is the owner's claim to the business assets. It is the amount of assets that remains after subtracting the liabilities. We also sometimes call it capital. So just pay attention to the assets and owner's equity. Asset is the asset owned by the business, right? Owner's equity is also an asset, but is owned by the owner, not by the business itself. So that is owner's equity. People get confused like saying owner's equity is assets. It is assets, but it's not as the assets you talk about from the financial statements. It is owned by the owner, not by the business itself. Okay, so so we're going to see a lot of practices regarding owner's investment or owner's withdrawal. Those are all under owner's equity, and there are also some other terms combined under owner's equity, like revenue. Okay, so capital is the owner's investment. Withdrawal is the cash or assets distributed to owners. Revenue is the amount earned or expenses, the cost of doing the business. So those are all under owner's equity, the 4 terms. Remember that term is assets minus liabilities equals owner's equity, okay? So it's also referred to as a net assets. This increase or decrease. Transactions increase and decrease owner's equity. Owner's equity, if there's owner's investment in the business, then it's going to increase the owner's equity. If there's a revenue earned by the business, it's also increase owner's equity. If the owner withdraw the cash or assets from the equity, they're going to decrease the owner's equity. And also if there's expenses, it's going to decrease owner's equity. Revenue is easy to understand the revenue, right? Examples including like the service revenue is earned, or sales of merchandise is sales of product. Rent earned, interest earned, those are all revenue. Expenses is the amount that have been paid or will be paid for cost to incur to earn that revenue. So for example, if you're going to sell a merchandise, then any cost related to that sales will goes to expenses. Say salaries or rental, office rentals, or utilities. Everything related to the merchandise sales, they're gonna goes to expenses. So this is what it shows, like a rent, salary, utility supplies, or amortizations, depreciation. Now we expanded the accounting equation. Right? We know that assets equals liability plus owner's equity. Now we separate the owner's equity into investment and owner's withdrawal and the net income, which is revenue minus expenses. Okay, so just pay attention to this equation. It will help you to have a better understanding about what increased account and decreased another account, or the debit and credit rules. So this is the one we're going to use it. Now we're going to see examples about accounting for business transaction. Business transaction is any event that affects the financial position of a business and can be measured reliably. Example, Lisa Hunter, the owner, invests $250,000 to start a new business, HEC. We're going to use this example till chapter 4. So pay attention to that examples. It's always going to come in from the HEC company. HEC purchased land for a future office location and paying $100,000 cash. Now we're going to go one by one. I think it's better. Now we go first one. The owner invests $250,000 to start a new business. That is starting the new business. Right? What is going to increase? Invest $250,000. That's investment increase. Right? In the same time, cash increase, because you have to put a standpoint of the business. So the cash increase, which means your assets increase, right? Your investment increase, that means your owner's equity increase. So there's a dual entry policy for accounting, which means that if there is a business transaction happens, there are always two or more accounts get affected. So for each of the business transactions, there are at least two accounts get affected. One is the assets account. Another is the owner's equity account, right? One is the cash, another is the investment. So that's for number one. Number two, any questions? Better ask before we move on.
No, so far I'm okay.
Okay, good. It's gonna go full quickly because the chapter 1 and 2 is just a lot of stuff. Number two, HEC purchased land for a future office location and paying $100,000 cash. So that means purchase of land, right? So the land will be increased because it's under assets. In the same time, the cash will decrease because we're paying the $100,000 cash, which is the cash outflow. So decrease the cash, increase the land. That is affected by the same assets account, but with a different term, right? And number three, purchase of office supply. HEC buys stationery and other office supplies and agreeing to pay $7,000 within 30 days. So that means, did HEC actually take all the cash yet? No, okay, it's a liability. So that's a account payable increase. So that's a liability increase. That means the business owe money to the supplier. So increase, the same thing, the office supplies increase, right? Because we purchased the office supplies, so the office supply increase under assets, at the same time increase liability to $7,000. Step 4, HEC earns service revenue by providing environmental consulting services for clients. The business earns $30,000 and collect this amount in cash. That means earning of service revenue. Earning of service revenue, the company earns the $30,000 in cash. That means the cash increase, right? So the cash under assets is increased. And then the same thing, revenue. Revenue is under which account? Anyone know? We just talk about it. Revenue is under owner's equity, right? So that means owner's equity account increase as well because we earn service revenue. So now pay attention to the 4 because people get confused about that. Step 5, HEC performs counseling services for clients who do not pay immediately. Now HEC issue invoice, the clients will pay $25,000 amount within 1 month. So that is a earning service revenue on account as account receivable. Okay, so earning the service revenue on account, that is account receivable, which means account receivable increase. Account receivable is under asset, right? It's not under liabilities. People get confused about that. So account receivable is assets. We increase the assets, and in the same time, because we perform the service revenue, so service revenue increase, which means the owner's equity increase. So that's 5. Now, during the month, HEC pays $12,000 in cash expenses. Those expenses including office rent, employee salaries, utilities. Okay, so those are the same thing. Paid cash, which means cash decrease. So which means the asset decrease, $12,000. Expenses increase, right? So expenses increase, that will decrease your owner's equity, right? Investment and revenue increases will increase the owner's equity. Increase in withdrawal and expenses, that will decrease your owner's equity. So in these situations, when the cash expenses increase, that means your owner's equity decrease. Any question? No?
I'm good. No.
Okay, perfect. Yeah, so those 6, 7, 8 are the same. If you're gonna do a journal entry, it's gonna be exactly the same. Okay. Now, step 9. HEC pays $5,000 to the store from which it purchased $7,000 worth of office supply in transaction 3. That is payment on account. Okay. So because that means before we had the $30,000 liabilities. Now, right now, we paid half of it, right? Or not half, but $5,000 of it. That means our total liabilities decreased. So we have decreased our liability $5,000, which is account payable. And then because we paid by cash, our cash decreases, which decrease our assets. Now 10, step 10, Lisa Hunter remodels her home at a cost of $30,000, paying cash from personal funds. Because it's paying from personal funds, right? Then there is no effect on the accounting equation of a business. So there's nothing to do. There's nothing you need to do. There's no accounting, no business terms has been affected by this business transactions. Number 11, connection on account. Business connects $15,000 with 50% of the total owing. Okay. So this is $15,000 we received in cash. That means our cash will increase in the same thing, increase the assets, $15,000. And then the other account receivable, remember account receivable, which means that the clients owe HEC $30,000. That is account receivable, decrease, right? Because it's being paying $15,000. Then if you're gonna do a journal entry, you debit cash and credit account receivable. That is same thing. That is also affect the assets account. If there's connection on account, there's increase the assets, cash, decrease the assets, accounts receivable. Number 12, withdraw cash. So Lisa withdraw $6,000 cash. Well, if there's no specific saying, we assuming that withdraw $6,000 cash from the business account. Even though it's for her personal use, if it's withdraw cash from the business account, then it's gonna affect the owner's equity. Okay, so in those situations, our cash decreased $6,000 because it was withdrawal, and then it also decreased the owner's equity account. $6,000 has been taken out. So that is the transactions. This is also the examples you see from your tax book. It shows a detailed analysis from our tax book. Now, after you go through this whole examples, you should pay attention to some of the terms. One is the received, means if there's no saying like received on account, then that means you received in cash. Okay. If the customer pays by check, that we treat the check as cash as well. So it's the same thing. If there's received, that means the sales settled in cash. Sales on account, that means that the cash will be received. It's not received yet. So it's account receivable, which is under assets as well. Purchase on credit. Purchase on credit means it didn't pay yet. It will be paid in a later date. So that is a liability. Okay, so it's a credit. Purchase on credit. Paid. Paid means that cash has been taken out. So cash being paid to the owner. Payment on account means cash was used to pay a prior bill. So payment on account, that means cash was used. So just pay attention to those different words that will affect your journal entries. Now, this is a tablet or a formula, or whatever you call, just according to the business transactions we just went through. Now, we always say we put in a term like this, we put assets on the left side equals liability on the right side and owner's equity on the right side, right? Then for each of the business transactions, you will have a number affected. For example, the first one, that was the listed investment of $250,000. We know that we're going to increase the cash, $250,000. In the same thing, we're going to increase the investment under owner's equity, right? So we're going to increase $250,000 under owner's equity. So when you do go through each of these transactions, you should have an ending balance. That should be assets equals liability plus owner's equity. So that will make it balanced. If it's not balanced, then you have to looking for, then probably some errors happened in between. Now, questions? No, good. Okay, so we're going to keep going. And then the next chapter, chapter 2, we're going to do the same examples. We're going to do debit or credit. Okay. Now, prepare financial statements is the next topic. We talk about the financial statements. The 4 primary financial statements are income statements, statement of owner's equity, balance sheets, and cash flow statements. Okay. Now, income statements. This is the examples of our income statements. See clearly. So income statements. The income statements, sometimes we call a statement of earnings or statement of operations. It lists the revenue and expenses and shows a net income at the very bottom. We use total revenue minus expenses. This is kind of examples of a service company, which is consulting, right? It's kind of a service company. It's going to be a little bit different when you learn the merchandise company, which is products selling. If there are inventory involved, they're going to be cost goods, so more complicated. But for now, it's just for service company. That is how the income statement looks like. And statements of owner's equity. Statement of owner's equity shows the changes that take place in owner's equity during the period resulting from net income or net loss and personal withdrawal or investment by the owner. Okay, so always start with a beginning balance of the capital. If there is investment by owners, we add the end. If there are revenues of the total business, we add the end. The revenue, that's why the flow to make a financial statement, so we always make income statement first, because we need net income. That is the final numbers to get into the owner's equity. It works in here. If it's a net income, we add it. If a net loss, we have to deduct it. Then we less any withdrawal by the owners, and you have your ending balance. Now, pay attention to this statement, because when you do your assignments, or if you do your homework or quizzes, you will see those kind of questions. They give you a beginning balance of capital. They give you an investment they give you a withdrawal, they want you to calculate the ending balance. That's easy, right? But if they give you a beginning balance, ending balance, and give you investment and net income, they want you to calculate the withdrawal amount. That is the formula you're going to use. Okay. So the questions will be changed. Sometimes it changes. They give you whatever and want you to calculate withdrawals, or they give you the rest of the numbers and want you to calculate the investment. This is the formulas you're going to use. This is the one. The statement of owner's equity. I get so many questions. People are confused about how to calculate withdrawal if I have knowledge about a beginning balance and ending balance. Okay, so this is the statement of owner's equity to use for the calculation. Balance sheets. Balance sheets lists all assets, liabilities, and owner's equity for a specific point in time. You may notice that for balance sheets, there's always a specific date, like April 30th, 2019, December 31st, 2019. And for the owner's equity and income statements, they always give you for the month ended April 30th, 2019, which is a period. Okay, so for income statements, owner's equities always give you a period, but for balance sheets, it's always a point of time. This is telling the financial story for that time period, right? Whenever the balance sheet shows the financial position at the end of the period. So we also sometimes call a statement of financial position. That is a balance sheets. Statement of financial position. We're using balance sheets. The relationship among the financial statement, we already talked about it. So the income statements is always prepared first because we need the net income from the income statements to fit into the statement of owner's equity. Get to prepare for the second. When we finish the owner's equity, the closing capital balance will fit to the balance sheets because we need a assets equals liabilities plus owner's equity, right? So that is the ending balance of owner's equity we needed from the statement of owner's equity. So that's why we prepare income statement, owner's equity, and balance sheets in that order. Cash flow. Cash flow is the different statements we have talked about several times. The cash flow statements, it reports the cash receipts and cash payments during a period. So you can see that they give you the cash from the operating activities, from the investing activities, or cash from the financing activities. You need to separate all those cash into different activities. So that is how you know that was the cash used for. Most of the cash maybe goes for investment, or most of the cash goes for financing, right? So that is kind of a cash situations to talk about it regarding the cash flow statements. We're not going to talk about it in the financial accounting anyway. So that is for chapter 1. And two formulas from this chapter 1. Right? First is the net income calculation formula. You use revenue, deduct expenses. That equals to net income or loss. Okay, and the second formula we use is capital beginning balance. Beginning balance at investment by owner at net income minus withdrawals by owner minus net loss. That equals to capital beginning balance. So those are very two important formulas we learned from chapter 1. Just make sure that you memorize those two. So that is for chapter 1. Any question for chapter 1? If not, we're going to keep going for chapter 2.
I'm good with chapter 1. No questions. Thank you.
Okay, perfect. I'm going to move to chapter 2. Oh, I have 3 and 4 classes today. So chapter 2, the major topic for chapter 2, to introduce the concept of journal entry. Okay. Oh, okay. You're welcome. So journal entries. Journal entries and one of the essential concepts for introductory accounting and must be mastered. Okay, that is the very basic steps to help you to move on. Now, first of all, what are the key terms used when recording transaction? Oh, so this is the kind of the accounting cycles. You should have the accounting cycle pictures in your textbook. It shows around 9 or 10 steps, right? Chapter 1 outlines the business transaction as step 1. Then step 2, we move on to record transaction in the journal, and then you post from the journal to the ledger, and then prepared unadjusted trail balance. So chapter 3, because it's unadjusted, of course, we're gonna do some adjustment, right? And then when we move on to chapter 3 to talk about adjusted trail balance, then you should focus on the special journals, which is special business transactions we talked about in chapter 1. That's unearned revenue, prepaid insurances, prepaid expenses, right? So those kind of the things you need to make adjustment. That is the one we're gonna learn for chapter 3. Chapter 4 is the closing entries. So we closing the entries and closing the temporary account. And then we have our posting, our closing trail balance. Then the whole accounting cycle is there. That is the ones we're gonna learn from the chapter 2, 3, 4. So first of all, the terms, we talk about it. Account, right? Account is a basic component of accounting system. So the account shows all the increase and decrease in a particular assets, liabilities, or owner's equity. That is, assets equals liability plus owner's equity, right? Ledger. Ledger is a group of account. All the accounts of business grouped together from a book we call ledger. We should have examples in our textbook, but I don't have it in here. So think about journal. The journal is, you already know that, right? We journal the debit credit for each of the business transactions. Now, think about a bender. Each page in the bender we prepared representing one account. Then the whole bender will be the ledger. Okay, so ledger is kind of organize all the group of accounts. Okay. So accounting is based on the 6 types of accounts: assets, liability, capital, withdrawal, revenue, expenses, right? We have a good understanding of those from chapter 1. Now move on to the chart of account, trail balance. So the trail balance is just a list of all the ledger accounts. How am I going to get examples of the ledger and accounts? See if there is a account receivable, HEC, that was a business from Lisa Hunter, right? Chapter 1. See, one of her suppliers, account receivable, that is customer. So we see customer, one of the customer is customer A, and another customer B, and C, D, E, F. So if there's any account seeing there's account receivable happened for customer A, we record it in account. So that is account receivable, customer A, account receivable, customer B. When you finish for 1 month, all the business transactions finish it. We just combine those from customer A, B, C, D, E into one of the ledger. That is the ledger book we talk about it. So ledger is always a summarized of all the numbers. Okay, so that is a summarize of all the numbers. We're gonna see examples probably later, I think, but you could see there's examples in our textbook to show what it looks like. Now the chart here, the chart of account. The chart of account lists all the accounts by account number. We do not request you to memorize all of those numbers, but you should knowing that assets are normally numbered in 100 or 1000. So it's always start with 1. Liabilities is always 200 or 2000. Owner's equity 300, 3000. Revenue 400, 4000. Expenses 500, 5000. Right. So the fact that accounts of similar natures are grouped using similar numbers So that many companies using grouping is very helpful. And another way is because most of the company use a computerized system. So this will help the computerized system group all the similar accounts together. See, one is assets. Account receivable is always, no, cash, I mean. Cash is always being the first assets account under assets. So if assets start with 100, then the cash will be 110. Okay, account receivable is always following the cash under assets account. So if cash is 110, then account receivable will be 120. That is how they organize that. Like liability starts with 2, right? So the very first liabilities always start with account payable. So if it's 200 is liability, then 210 represent account payable. That is how this accounts number works. Oh, here we go, actually, to give examples from our tax book. This is from our tax book. Seeing assets, they always coming from cash the first. So cash is 1100 if start with 1000. Account receivable following 1200. Office supply 1400. Furniture 1500. And land is 1900. So you do not need to memorize all those numbers, but whenever you see a number like 2, so you know this is under liabilities. 5, you know this is under expenses. Okay. You don't need to memorize that because it's just a knowledge. How do we track changes in account? Now, this is double entry accounting policies was the one I mentioned at earlier of the class. Double entry accounting, that means each of the business transaction will affect at least 2 accounts. Okay, there always being a receiving side and a giving side. Now, the examples is what's given from the tax book is saying in a cash purchase of supplies, like office supplies. We spend money to purchase office supply. So this office supply will increase, which means the business received the supplies. And then the cash decrease because we use the money to pay the supplies, right? So the business gave cash. That is the receiving and the giving side. Very similar to purchase a truck, increase the vehicle. So the business received the truck and make with a bank loan that is a payable, right? It's a liability, so account payable. So that's give a promise to pay in the future. That is increase account payable. That is double entry accounting, very important. So just make sure that. That's why a lot of students cannot get balanced when they try to do financial statements. That's because you have to pay attention to the double entry accounting to make sure each of the business transaction affect how many accounts in your accounts book. Now, T account. T account is just a tool. It's a form of a ledger account. Okay. So we have seen that account receivable for customer A, they will have debit or credit. For customer B, we'll have debit and credit. Right? Then we move all those customers' ledger book into one ledger book. Then this should be account receivable and A, B, C, D, E, F customer. Then we should have a total number of this account receivable for the whole company. Right? Because for each of the business, for each of the customer, you should have a balance. Seeing that for customer A, they purchased 100 products from HEC, and then they owe $100,000, and then they paid off $15,000. So the balance should be $15,000, right? So for each of the customer, they should have a balance, and then all those balance will combine into one ledger account. So that is the ledger means you should have an overall balance. That is the ledger. T account is just help you to have a better understanding. We see always have account title at the top, debit on the left, credit on the right. Okay. You might think debit means good or credit means bad. No, it's not works that way. Debit, it just means on the left. Credit just means on the right side. So do not take into, people sometimes will think debit is good one because your debt increase, that means your cash or assets increase, right? It's not, it doesn't work like here. And also the same thing, if you're working in the bank, you will know if you have increased your debt, that means you owe more money to the bank. Okay, so this means a bad thing, but it doesn't work in here. So pay attention to the T account. The debit side and credit side simply means the left side and the right side. Okay, it's just to help you to do the calculation of the balance of the account. Okay, so pay attention to that. I have a lot of students who have questions about the T account. It's not, the debit side is not always good or bad. There's nothing about good or bad. It's just to represent the side. So that is the T account. You're gonna use T, you're gonna see T account a lot whenever we have business transaction or we're gonna do a journal entries. Now, accounting portion and the rules of debit and credit. Now, here you come. Here is the tough part. Assets increase on the debit side, decrease on the right side, which is on the credit side. Liability increase on the credit side, decrease on the debit side. Owner's equity increase on the credit side, decrease debit side. How are you gonna remember this, right? People are gonna confuse about how are you gonna remember them? There is a called hand game. Debit and credit rule on YouTube. This is a very good videos I find that help you to memorize what you're gonna increase, what you're gonna decrease. Nor basically they just simply separate debit and credit from assets to owner's equity. Okay, just quickly show my face with you. So what they say that this is a 6 that represents your debit side. This is 3 that represent your credit side. So assuming I'm a T account, okay, I'm the T account. So this is debit, this is credit side. Now, assets, liabilities, right? Investment, owner's equity, owner's equity, beginning balance. And then we have revenue, expenses. So remember those expanded equation we talked about in chapter 1. There is an expanded equation balance, right? So we're seeing that debit side, assets increase is on the debit. Okay, liability decrease is on the debit side. Owner's equity decrease is on the debit side. Revenue decrease on the debit side. Expenses increase on the debit side. On the credit side, assets decrease on the credit side. Liability increase on the credit side. Owner's equity increase on the credit side. And revenue increase on the credit side. Expenses decrease on the credit side. So that is the one to help you to remember what is increase and what decrease. Okay, so if you have time, go searching for that video. It will have a not better explanation. They will have a form to show you for each of those accounts, and then they will show you the hand game to help you to remember. Now we keep going with our lectures. Any questions on this? No, good.
No,
Okay.
I'm good, thank you.
Yeah. Okay, so that is actually have a better explanation of this or template in our textbook. You will have a better understanding and hopefully it will help you to remember everything, like what is increase, what decrease. Okay. Now we quickly move on to the examples. That is example we talk about it from chapter 1. Let's say Hunter invested $250,000 cash to start her business. We had analysis, right? We know that the cash will increase, owner's equity will increase too. So when we move on to the T account, cash increase goes to, remember the hand on the 6 on the left side, right? So that is a debit. So cash increase, debit increase 250. Owner's equity increase, that means it gonna goes to credit side. So owner's equity increase $250,000. That is how that works. Owner's equity goes to credit side. The second one, Lisa Hunter invests $250,000 cash to begin the HEC. We already know that. And there are $100,000 cash purchase of a land, which means our land will increase $100,000. The land, which is assets, asset increase goes to left side, debit side, okay? Oh, yeah, land. So the land increase $100,000 on the left side, which is debit. Cash we spend to purchase the land, so on the credit side. So under cash, after those two business transactions, we could simply see that the balance of the cash will be $150,000. Right, so that is why we use a T account for. So we could know that exactly after 1 month of the whole transaction, what is the balance of each account. So for the cash, the balance will be $150,000 because we had $250,000 come in, then we spend $100,000 for the land. So the balance will be $150,000. This is the one we just talked about it. It's expanded the rule of debit and credit. It's also used this for the hand game for debit and credit rules. So this is the form. This is also the template you want to memorize it, which will help you to understand which one goes up, which side you want to go. Okay, pay attention to this one. Memorize it. Very important. That is the major ones in chapter 2. Okay, normal balance of account. A normal balance of account is the side used to record increase. Account that has a negative balance, which is the opposite of its normal balance, may indicate that an error has been made. So one way to memorize this, this is coming from our textbook. Besides that hand game for debit and credit rules, this is like an AWEROL, Dr. Ollie. So it also help you to memorize which one goes to debit, goes to credit, or increase recorded. Okay, how do we record business transaction? Source documents. Source documents are the raw materials that provide evidence of a transactions. For example, the bank deposit slips, right? So the bank deposit slips shows amount of money received by the business and then deposited in the bank. Purchase order is the not purchase order, purchase invoice. That is documents to tell the business how much to pay and when to pay the vendor. Bank check documents tells the amount and the date of cash payment. Sales invoices, a document sent to the customer when the business sells goods or services and tells the business how much revenue to record. Those are all the source document. You will need to, I don't know if the textbook give you exhibit about each of those source documents, because when you move on to level 2 course, which is for chapter 7, you're actually going to use all those source documents to make a journal entry, like the sales or purchase or bank statements, so on. Journalizing, recording transaction in the journal. I'm going to talk about that. Transactions are recorded first in the journal and listed all the entities' business transactions. Most transactions are recorded based on a source documents. So let's talk about that, which will provide the evidence that the transaction has actually happened. So the process of journalized transactions, we identify the transaction from the source documents. The examples given, if it's purchase, if it's a sales, right? If it's just a deposit. And then we'll do an analysis to identify each account affected by transactions. Remember the double entry rules, we just talked about it. So each of the transactions should affect at least 2 accounts, Then we move on to accounting equation to verify the accounting equation is still in balance. Then you just simply put it into a journal entry with debit and credit. Journal entry will look like this. If you see a question ask you to record a journal entry for the business transaction, you always follow this template. You start with date, you start with account, title, and then debit, credit. Okay, so you can see a cash, 250,000, and credit, capital. So always following this format. Because I guess students just simply listed all the account and just summarize all the debit together, and then all the rest of the other account and summarize the credit total account. That's not the standard journal entry format. Okay. Each journal entry should have their own debit and credit and also their own date. Now, what is the next step after recording the journal entries? Is the posting. Okay, so posting is transferring the data from the journal to the ledger. Now that is, a T account can be used as a short form for a ledger. So every time you record a journal entries into a T account, remember each of the business transaction happened, then we record it into their account, right? See the cash, $250,000. And then the next journal entries will be spent $100,000 to purchase office supply. Then the cash will decrease $100,000 on the credit side, on the right side, right? So simply we'll have a balance of cash that will goes to the journal ledger. How can we check if the records are in balance? So that is the trail balance we used. Trail balance is a listing in general ledger orders. So like cash, accounts receivable, office supply, furniture, land, and capital assets. So in general ledger order of the debit or credit balance in each amount. Simply. So assets first, followed by liability, and then owner's equity, revenue, expenses. There you go. So this is examples of a trail balance. You can see which is following, right? Assets first, and then liabilities, and then the capital withdrawal, right? So we simply listed all the account, and then we balance the debit total together, credit on the right side, and at the very end, it should keep balanced. Total debit should equals to credit. If those two numbers are not equal to each other, you have to go back and check if you did make something wrong. Right, so that is the problem, finding, correcting the trail balance errors. So sometimes there are mathematical errors. When you add the n, debit doesn't equal to credit, then you should do recalculate it and make sure there's no mathematical calculation errors. Then if the calculation is correct, then you have to take a look at each term to make sure that the numbers you entered is correct. Because if it's hand transferred from the journal entry to the trail balance, the number probably is miscopied, right? For example, if they're supposed to be 567, then you write down as 657, right? So that is a kind of digits are written in the wrong order. Okay, so if it's written in the wrong order, then you should have to search for these arrows and then correct it. How are you finding which number is correct is wrong? The transposition, which is the digit are written in the wrong order, those arrows is always divided by 9. So seeing that when you till the very end, right, the two numbers are not the same. We calculate the difference between those two numbers and divide by 9. It should equal, it should be evenly divided. So for example, if it's 90, so if the differences between credit and debit is 90, we divide by 9 equals to 10. So that is evenly divided, right? Then that means there is a transposition errors happen somewhere. So you have to check the numbers to make sure the number is correct. So that is also the errors happened mostly. Another errors sometimes happen is a slide error. So that means one or more zeros are added to. So it's supposed to be a number 1000, or sometimes it's reading as 100. Then we're missing 1 0, right? It's the same thing. You can simply divide by 9, and then that means there's a slide errors. But anyway, whenever you check the debit and credit, if it's not equal to each other, there must be something wrong. So you have to go back and entering and checking the trail balance and also check your journal entries to make sure the number is correct. Okay, so that's it for chapter 1 and 2. Any questions? I know there are lots going on there, but hopefully you will have time to read your book and then doing some exercises. It will help you to have a better understanding, especially the hand game, the debit and credit rules. Sorry, what's your question? Any question?
No, thank you. I don't have any question. It was a great class. Thanks a lot.
Thank you.
See you tomorrow.
Yeah.
I believe we have now we have class on 15th, right? Which is Thursday.
Thursday. Yes,
Yeah,
exactly.
right.
So we're gonna have a Thursday, 15th.
Yeah.
And then
You have
hopefully
20th.
I'm still in the 20th. I'm not sure if I'm still gonna be in 20th, probably gonna go travel. But if I'm not in, I will post my recordings so you can go and watch the recordings.
How about 22nd?
Yeah, the same thing. If I'm leaving
Same thing?
20th,
Okay.
I'm not gonna be available 22nd.
Okay, no worries. Okay,
Yeah.
you have a great day. Bye.
Yeah, you too. Thank
Thanks a
you.
lot. Bye.